Hi there, everyone. Thank you very much to Jules and Lily for the introductions to the conference and to the speech. It's with a lot of pleasure that I am on the front of the agenda this morning. I always look forward to our Mortgage Innovation Summit. It's the 12th time that we've done this, and I think I've spoken at every single one of those conferences over the last 12 or 13 years. What I'm going to talk about today, really, my role here is to set the scene, I think. So I was challenged by Lily to talk about what was coming up in the mortgage market in this year and what would happen beyond that. I'm also going to look back at the year that was, and I'm going to talk to some of the most surprising things that I saw happen in the mortgage and the property market over the last over 2020. And then I'm going to take a view of what I think, based on the data that we collect and the insights that we derive through all of the consumer and business interviews that we conduct throughout the year, what we think is going to happen going forward. Three kind of areas of the agenda, and I'll kind of talk to each one of these in that order. So starting off with those surprising things from 2020, and I'm going to try in that section to pull in some international insights. I always think it's useful to compare how Australian sentiment or Australian borrowers are behaving relative to their sort of counterparts in other markets around the world. And as a company that collects data from a huge number of different markets around the world, it's always really pertinent to bring up those comparisons. And then I'm going to go into the outlook for the next 12 months, and then we're going to look at the sort of opportunities and any kind of headwinds or speed bumps that we might see from 2021 and beyond. So let's start off with the most surprising statistics from 2020. And those of you that have seen any of my presentations in the past will know that I do like a good data point, and I am not ashamed of that in any way, shape or form. I do get quite excited by charts and graphs, and I'm a very visual person when it comes to data. So I like to see lines and columns and bars, and there's going to be plenty of that as we go through. So I think, as we came into 2020, we weren't necessarily in a great place from an Australian perspective. The end of 2019, if you can remember back that far, was punctuated by the bushfires and one of the worst bushfire seasons that we'd ever had in this country. And for many of us, the summer of 2019, 2020 was categorized, I think, by days where you couldn't see the sun in the sky, you couldn't necessarily see the horizon for all of the smoke and dust particles that were in the air. So as we looked at consumer sentiment coming into 2020, to say that we weren't in a good place already is probably an understatement. You look at the Westpac Melbourne Institute Sentiment Index. It's always my sort of go-to measure in terms of how consumers are feeling at a national level. When the line is above 100, it means that there are more optimists than there are pessimists in the market, and vice versa. When the line dips below 100, there are more pessimists. And effectively, coming into 2020, we were already in a very, very sort of relatively pessimistic place, and the line of sentiment was trending downwards, albeit with sort of dips and bumps. So to say that 2020 was a volatile year from a sentiment perspective is probably the biggest understatement that I'm going to make. We saw sentiment dip into the 70s in April 2020, a level of sentiment that we hadn't seen since the mid-90s when interest rates were in the teens. But what was evident, I think, through 2020 was that consumers were very resilient. And when there was good news, we tended to react to it very well. And so you can see, we had our dip in April. Coming into May and June, things started to look better and sentiment picked up quite significantly. Then Victoria went back into lockdown, and the dip in consumer sentiment was almost as large as it was in the initial wave of the pandemic. And since then, sentiment has picked up and continued to pick up, really, and actually is at level there. If you follow the blue line across the top, consumer sentiment coming into December was as high as it had been for 10 years. And so we had this kind of real roller coaster ride of emotion through 2020. One thing is for sure, I do not think anybody, hand on heart, would have said April that they expected consumer sentiment to rebound in quite the way that it did. One of the other sort of areas of surprise, I suppose, was around the mortgage market. Now, probably not surprising was that when we look at data for the first half of the year, so what proportion of consumers said that they expected to struggle in every month over the next 12, Australia or Australian borrowers, 5% of them said that they were going to struggle every month. And you can compare that to a couple of similar markets. I always like to look at the UK and Canada, just because as a kind of general population, we're not too dissimilar. In the UK, there was less stress in H1 compared to Australia. In Canada, there was significantly more stress. And what's interesting, I think, is that as we moved into the second half of the year, we saw that stress in Australia and the UK dip back to kind of longer term stress levels. We always expect, if I could say that in another way, that there will be 2 or 3% of people in the mortgage market that expect to struggle to meet their mortgage repayments every month. The good news was, coming into 2021, that stress level had dipped back to that longer term level. It's also interesting, I think, that the Canadians had continued to see more stress. They were already more stressed generally as a borrower group in the first half of 2020, and they saw an increase in that stress coming into 20H2. So borrowers were under a bit of pressure. They were worried in the first half of the year about their income and the knock-on effect that would have on their debt and their ability to service that debt. But there is also another side to this, which is that if I overlay this with the proportion of borrowers in each of those markets that says they're going to overpay, what it really highlights to me is that we as a nation in Australia are a nation of overpayers. We put pressure on ourselves to overpay on our mortgages. And so, that's a double-edged sword. In one sense, it gives people a buffer, but in another sense, it means that when they can't overpay on their mortgage, that they sometimes translate that as stress around their debt serviceability. So compare that: 52% of people in the second half of 2020 were going to overpay in Australia to 22% in the UK and 17% in Canada. And you really start to get a feeling, I think, of where the pressure was in the market and to what extent it was people putting themselves under pressure because they have that desire to get down their debt as much as they possibly can, versus what was going on in the market and the economy at the time. The other thing that's very true of Australians is that we are very property focused. We always talk about the Australian dream of property ownership. What's interesting, I think, from a banking perspective is that when you look across different markets around the world and you say, all of the people that are in the market for a banking product, what proportion of those are looking to take out a mortgage? And you can see here that in Australia, that group of people looking for a mortgage makes up the largest proportion of all kind of future product uptakers relative to other markets around the world. So that kind of desire to take out a mortgage, that desire to get into the property market, expand on property ownership, upgrade, downgrade, whatever it is, comes through in those numbers quite significantly. And if we pick, I was comparing Australia to Canada and the UK on the previous slide. If we take those two markets on this slide, Canadians who are looking for a mortgage made up 12% of all people that were looking to take out banking products in the next 12 months. And in the UK, that percentage was 7%. So, Australia almost, sort of 3 times as high as the UK and twice as high as Canada, is kind of a good benchmark to think about. So we are keen on the property market. And as a result of that, with sentiment being somewhat volatile, with that desire to take out mortgage debt, the credit demand within the market was also a bit of a roller coaster. So I think, if you look at the blue line on this chart here across the middle, effectively it shows you that from about June onwards in 2020, the demand for mortgages was increasing. And actually the December 20 quarter for mortgage, we saw the number of credit applications increase by 19.3%, which is unbelievable. And again, I challenge you to have looked back to April or March 2020 and to have predicted that increase in demand within the mortgage market. The other interesting thing I think on there is that we talk a lot about buy now, pay later, and it is almost impossible to have a conversation in financial services or to read anything about financial services that doesn't mention buy now, pay later. And actually demand for buy now, pay later in the December quarter, when I think many of us might have expected it to increase, actually reduced slightly during that quarter. So there's some very, very interesting statistics that none of us would have predicted in 2020. One of the things that I think knocks on from that demand for mortgage debt and that desire to get into the property market is prices. So you look at the residential property price index across the capital cities of Australia, and in every quarter in 2020 we saw price increases, and the outlook for price in those cities over 2021 is also very positive, with property price increases expected to continue through the year. And I think I read somewhere the other day that in Sydney those kind of growth expectations in prices were almost approaching the double digits over the 2021 period. So property prices did improve, will continue to improve, and I think probably one of the last or least expected things that I was anticipating was that through 2020 we would see an increase in the both in the number or value of borrowing by first home buyers, but also an increase in the proportion of all loans that are given to out to first home buyers. So now, first home buyers at the end of 2020 accounting for nearly 1 in 4 of all mortgage loans, and the value of $5.7 billion, significantly up year on year, and well above the sort of longer term average that we'd seen or come to expect, I think, over the last few years. So first home buyers actually coming into the market in a way that few would have predicted leading into the pandemic. So was 2020 surprising? Absolutely, on so many levels, both from a could it have been any worse, but also in some of these statistics from a very, very positive in terms of sentiment, in terms of property demand, in terms of mortgage demand, etc. So I think it's easy to look backwards. It's less easy to look forwards. Where do we expect the market to go in the next 12 months? A question that we get asked a lot, and something that I think as a provider of data and insight to the financial services community, I think something that we need to be able to do is to say, this is where we believe the market's going to go. One of the things that I'm very, very confident of leading into 2021 is that demand for mortgage credit is going to continue to grow. If you look at the growth in owner-occupied mortgage demand between January and December last year, it grew by 25% based on our expert data, which is a survey of 63,000 consumers that we do every year. We saw a 4% increase in investment mortgage demand. We also saw, other product demand sort of stalling or falling back. So, term deposits, credit card demand declined quite a bit over the 2020 period. Savings account demand held up. So 2% increase in demand between January 2020 and December 2020, which is, as we saw from the APRA data, the balances in savings accounts of all of the major banks increased significantly over that same period of time. And, this is in an environment where people are unsure about the economy and unsure about their personal economies and wanting to put money away just in case. And so that savings account demand is coming through there. But yeah, the real winner is the owner-occupied mortgage, where the demand went up by 25% over that same period of time. And before I sort of move on to the next slide, I will just mention that, as at December 2020, the demand for investment products like share trading accounts and mutual funds had increased by 15% as people looked for returns outside of cash where they could get it. And I think maybe a coincidence, but I'm not so sure that it was also, leading into January 2021 was the kind of the GameStop phenomenon from the sort of Reddit users, and maybe that demand for investment products and share trading accounts has increased even since December as a result of that. So demand for credit is going to grow. What we reckon, based on our expert data, is that about 11% of all consumers are intending to take out a mortgage in the next 12 months. That's nearly 2.2 million mortgages that are going to be needed in 2021. So, if you look at that and you see opportunity, then I'm with you. Of those 2.2 million mortgages, there's going to be just shy of 700,000 of those will be for people who already have an owner-occupied mortgage and want to take out another one. Either they're refinancing, switching, or purchasing a new property. 740,000 of those will be first home owner-occupied mortgages, and 725,000 of those will be for investment property. So the sheer number of consumers that have an intention to take out a mortgage in the next 12 months means that from an acquisition perspective, there's kind of ample opportunity in the market. And a lot of that activity will occur amongst the existing customer base. So if we look at existing borrowers and we see what sort of activity they're expecting to do in the next 12 to 24 months, there's two sides to every statistic. On the one hand, 58% of them aren't intending to do anything, but that means that there's, more than 4 in 10 are intending to either renovate or buy an investment property, to upgrade, or to downsize. So that sort of activity amongst existing borrowers is very real, regardless of if you are a major bank, a mutual, or a non-bank, or an ING. Doesn't matter. Your customers have a reasonable amount of desire to take action over the next 12 months. And that demand for mortgages is not just restricted to existing borrowers. If we look at non-borrowers, then there's also a kind of latent demand to get into the market. In fact, 7% of all non-borrowers have some sort of intention to get into the mortgage market in the next 12 months. On the top two charts here, you can see where that demand spikes. So no surprise, 25 to 34-year-olds more likely to be intending to get into them to take out a mortgage in the next 12 months than other age groups. And on the right-hand side at the top there, the higher the household income, the more likely the household is to be looking to take out a mortgage. That opportunity amongst non-borrowers exists. And of course, they are likely to be customers of yours already as well. So if you're a banking provider in the market, look at your MFI customers, 7% of those that don't currently have a loan will be looking for a loan as a base. If you are an online bank, then that figure could be as high as 16%. If you're one of the international banks in the market, that figure could be as high as 12%. So The key here, though, and we'll come to this in the next section, is that those customers are looking to get into the mortgage market. That doesn't mean that they're coming to you. And that's something that we need to absolutely take into account. And we'll do that, I think, through this kind of opportunities and speed bumps section, where we'll look at, what are it's all very well and good to look at the acquisitional side of things and where's the opportunity in the market. But, those consumers are not just going to walk through the door or visit our websites without some work. So what are the key things going to be to look out for? One of the biggest things I think to watch out for is refinancing intention, and particularly the orange line on here. So the blue line represents the people who are intending to refinance a loan with their existing lender. The orange people are people that are looking to refinance and switch to a new lender. 10% of consumers 10% of mortgage borrowers in December 2020 said that they had an intention to switch their lenders. That is a relative high. We've seen 10% in the past. We saw it in March 2019. We saw it in September 2016. But it's still, by comparison to our longer term trend, very, very high. And the interesting thing, I think, is that when you look at that sort of intention to switch, one of the big things is the question that gets asked is, why is that? Why do people who have a loan with an existing lender think that they should go somewhere else to a different lender? And what we've seen over time is that, depending on the economic cycle and depending on where rates are at and how easy it is to get credit, when you talk to borrowers and you ask them whether they are going to consider their existing lender for their next mortgage, we get variable results. In December 2019, the proportion of borrowers who said that they'd consider their existing lender first had dropped to 42%. That was really low in comparison to what we capture as a long-term average. It picked up during 2020 as a result of lenders being willing to lend outside their existing customer base is perhaps dwindling slightly. Consumers finding comfort in familiarity and brands and the stability that they see in that familiarity. So we saw that percentage increase to 50%. But 50% to me is not a very high result when we're thinking about existing customers and where they will go for their future mortgage. I think we want that to be higher. Part of the problem, of course, is that there is an increasing awareness of pricing within the market, and every time we price our borrowers unfavorably, we give them a reason to shop around. And RFi research has shown that, and you can see it on this slide here, that 61% of all borrowers in the market feel that their lender offers more competitive products to new customers compared to existing customers. So that doesn't help. If we want that 50% of our borrowers considering us first for their next loan, then we've got to be working on this perception that we are unfairly, in their view, favouring new to bank customers versus those customers that have been, as they would see, loyal to us as lenders. So the stats across the board there do vary somewhat, but I don't think for any bank or for any lender that looks particularly good in terms of those percentages. And what we know is that when borrowers feel like they're getting a rate that is higher than other rates that are in the market, they're less likely to consider their current lender first for a future loan. I mean, it sounds obvious when you say it, but if you look at the statistics on this slide, if I think my rate is a lot lower than others in the market, then 67% of those people are likely to consider their existing lender first for a loan. If I feel like my rate is a lot higher than others in the market, then the proportion of those borrowers only considering their lender first is 24%. So it's night and day in terms of that percentage difference. So we've got this market where we've got an increase in mortgage demand. We've got lots of people looking for a mortgage, whether it's their first mortgage or a subsequent mortgage or an investment mortgage. And the there's an increasing disconnect between the existing lender and the future loan. And so, and then there's also this increase in the proportion of consumers that are looking around in the market, whether that's to switch or generally just to refinance. Against this backdrop, of course, we've got open banking. So our data shows that about 30% of all consumers would find the concept of sharing access to their banking data in return for better products and services and pricing from a prospective institution to be an appealing concept. And actually, when you turn that into a mortgage, specifically a mortgage-related question, and you talk to borrowers about, what sort of benefits would encourage you to give a new lender access to your personal banking data, you can see on this slide here that something like 65% of borrowers at the top there would say, if a lender could offer me a lower interest rate or more favourable terms on my loan, that would be, enough to encourage me to share my data, or it might well kind of sway me to encourage me to share my data. So, we tell a story here around, we'll call it loyalty, but brand. Where does your brand fit in when a consumer is thinking about their next mortgage? Are they more likely to be looking around for a mortgage? Yes, they are. Are they more likely to be? Are they likely to realise that if you've got an unfavourable price point for them, that is unfavourable relative to the market? Most of the consumers that we speak to are aware of that, and if someone else comes along and can offer them a better deal, then they're likely to be encouraged to look around. So I think that's a really big thing to be thinking about as we go into 2021 and 2022. Not just are you looking at the opportunities within open banking, but are you looking at the how you mitigate some of the risks that's going to present in the market. The other sort of angle on this that I think is really important is asking yourself the question of what chance you have of retaining customers going forward. If we've got 11% of all borrowers at the moment are looking to switch their home loan to a new lender, are they going to? What's the first you'll hear about it? Are you going to hear about it because they're going to come to you and they're going to request a pricing discussion or a different price point, or are you going to hear about it for the first time when they put in their discharge form? The answer to that will depend heavily on whether they're a direct customer or a broker customer. If they're a broker introduced customer, 63% of those borrowers, if they were looking for advice around switching their mortgage to a new lender, would go to their broker. Only 10% would go to their existing lender. So 1 in 10 of those borrowers are going to have a conversation with you prior to you seeing them walk out the door. So what is your chance of retaining that group of consumers? It's not great. Even for direct borrowers, they are in only 19% of cases likely to come to you for advice around that switching process. They're more likely to go to another bank or another lender in 25% of cases, and they're as likely to go to a broker to seek that advice. So I think that's a real kind of call out. And the more I see what's going on in the market, and the more I see the way that we're using data, whether that's in an open banking context or not, the more I hear about the sort of the usage of AI within the market. And I see that as being the sort of big thing as we move beyond 2021, is how do you get ahead of the switch effectively? How do you have a conversation with customers before they're actually kind of handing in their discharge form? And that's kind of where AI comes in. And I know we're going to cover off a lot of these things today through some of the technology discussions that we're going to have. We'll talk about the open banking side of things through some of the regulatory conversations that we're going to have. But I think for me, that's a really interesting space that we're moving into that is going to help to if you're harnessing it properly, going to help to retain. But is also, a tool that your competitors are going to be using when it comes to acquisition. And, bearing in mind, of course, that the customer that's looking for a mortgage, just because they're a customer of yours today, doesn't mean that they're looking for their mortgage with you. And they might well have bank accounts elsewhere that could be harnessed from a data perspective. So just to round that out, I think nobody could tell you, I don't think, hand on heart, that 2020 wasn't one of the most surprising years that we've had, but also surprising in an Australian sense, in that we saw demand for property and demand for mortgages increase, and that had a knock-on effect on prices, and it will have a knock-on effect in terms of mortgage demand in 2021. It's going to be very busy. You're going to have potentially 2 million new customers looking for a mortgage in the next 12 months. And that, those mortgages are going to be they're going to be for first home buyers, they're going to be for subsequent home buyers, they're going to be for investors. At the same time, we've got open banking promising to make it easier for your competitors to eat your lunch, to offer proactive pricing in order to entice those customers and to get them to share their data, which is going to be both a challenge but also an opportunity for you all if you can use it to your own means. And at the same time, we've got challenges to loyalty. Loyalty is looking quite shaky. We have more customers looking to switch at the moment than we've had for 18 months or so. We've got customers who say that when they're looking to switch, only 1 in 2 of them is looking at their existing lender. And so the question becomes, how do you engage those customers in a conversation to have any chance of retaining them? If they're predisposed to going to a broker or to another lender over coming to you to have that conversation. And I think that's where AI and explainable AI comes in. The ability it gives you to get ahead of those switches, to identify who are the specific individuals, what are the specific insights that I need, and what are the specific sort of next conversations that I need to have in order to get a better retention outcome and garner a more loyal customer base. So those are my thoughts. I think that we'll come back to a lot of those points as we go through the agenda over the next couple of days. I'm really looking forward to seeing what some of the other speakers have to say. Thank you very much.